Happy Tuesday, everyone. It is day after Memorial Day. Hopefully everyone's full and rested and ready to start the summer. We're back once again. We took a little hiatus to enjoy the long weekend. We had some beautiful weather, and but yeah. So, hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name's Kirk Chisholm. I'm once again joined with my good friend Doug Hagren. Hey, Doug.
Hey Kirk, happy post Memorial Day. On to the long stretch before the next holiday.
Yeah. Well, you were telling me earlier you got a lot of sports in, a little tennis. How did that go for you, Doug?
Excellent. I grew up playing competitive tennis. I love the sport. Still play it, and now I got kids that are asking me to teach them and play with them. And every parent's dream, right, is to have their kids have some of the same passions you do. And so, nothing better than being woke up at 6:30 in the morning on Sunday after playing all day tennis on Saturday, and have my son go, "Can we go play again, just you and me?" So, yeah, it was a lot of fun.
Yes, it's a dad's dream to have the kids want to help you refill your high school hero desires. I know I do.
It's living vicariously through them. It's, for every parent knows this. It's almost the same thing as doing it yourself. Almost.
Almost. Awesome. Well, let's just dive right in. So we got a ton of new news. So Doug, where do you want to start this week? We got a ton of new stuff to talk about.
Well, I think last week I think you even sent it to me. Like, what happened with mortgage rates? And the last week and a half, they went from about they were starting to see rates as low as 6.5, and they spiked up well over 7, and they're on their way to 8. It looks like so. That's going to be a very actually. I think you saw that they are showing maybe even over 8. Although I'm not sure the average everywhere is seeing that. That's a heck of a spike. I mean, you're talking in a probably about a 2-week period, an escalation of the interest rate of 1.5%. And I don't know what that off the top of my head. I didn't run the numbers and crunch that of what that translates to in extra dollars per month, but it is big time.
It's a lot, Doug.
It's a lot,
It's a
several
lot.
$100s a month.
Yeah.
And then on top of that, they were talking about the debt ceiling. A lot of stuff still trickling out about what could happen there. I can't, I think it's as of the time of this, I don't think they fully signed it yet, but it seems to be that they are in some sort of an agreement of things to come. And one of the things that also is coming into that we could talk about is student loan debt. And now, obviously, for the last 2 years of COVID, that's been something that has been put on the table. People haven't had to pay it. You and I both know, Kirk, as we've looked at these charts over the last year or so, talking to each other, we've seen a steady rise in outstanding debt in the area of mortgages from homes that were purchased that were very expensive, since 2020. You look at the rise of credit card debt and other consumer debt. You look at the spike in auto loans, which are now some of the most egregious loans you can get out there. They're, in many cases, they're at credit card rates, 12% to 15% to get a car loan, but people are still getting car loans. You start adding all that up, cash flow is getting really, really was already getting tight, but now you just put an absolute sledgehammer to household budgets.
Yeah, I think, we're showing this slide here, and for those of you listening, I'm just going to describe it so that you don't have to scratch your head and say, hey, what are they talking about? So on Saturday, I pulled this up on my phone and I just Googled it, average mortgage rate. And apparently I spelled mortgage wrong on my Google search and it still found it. So average mortgage rate, this is the 25th. So I guess maybe it was Friday. I don't know, whatever the 25th was. Either way, I Googled it and this is what came up. 8.164% for 30-year fixed. That's the average rate. So if you're going to your bank and you're like, why can't I get that? It's the average rate. But across the whole country, it's probably going to differ based on all these other metrics. So just take this with a grain of salt. The 15-year fixed, 6.74%. The 10-year, the 10 and 6 arm is 7.567%. Now, it wasn't so long ago that rates were 2.5% in 2021. Up until recently, it was about 7.25%. And as of the debt ceiling problem, it's now as of right now, Well, this is weird because it's showing May 26th for the average rates when I Googled it. It hasn't updated. It's still showing that rate, May 26th, but it's 8.0%. So it's still in the eights. Now, I look at this and say, all right, what can we pull from this? Well, here's one thing we can pull from it. Your interest payment, your monthly mortgage payment, is more than doubled of where it was in late 2021. More than doubled. Now let's say it's doubled. 7.5 is technically doubled. Let's say it's doubled at 7.5%. Now it costs you twice as much to own the same house. Or reverse that, you can afford half the house at the same payment. Now, I'm going to go through this framework quickly because most of you have already heard it, but I'm going to do it again because it's so important. If you can afford half the house, it means you can't afford this new house that's an upgrade or even for what you already have because it costs twice as much. Now, maybe you can afford it, but most people can't. So just understand that this is going to put a cap on house prices. Now, if you look at, I'm going to show you this real quick. In a second here. So I'm going to show you this chart of the U.S., which I think is really important to recognize. And for those of you listening at home, you can just kind of go to the YouTube channel and you'll be able to see this. But this is a picture of the U.S. And this is in Reventure. You can get this. You can download this yourself. But basically, it shows you house prices in the U.S. and it shows affordability. Red is bad, blue is good. So let's look at the middle of the U.S. and I'm picking on Kansas. House payment as a percentage of median income, 13.5%. Well, I think your rate is capped at 30%. Generally, I think banks don't want to see you with more than 30% income to house payment, and that means it's generally affordable and you're not going to put yourself into danger. So you could afford twice the house based on this that people are affording based on median home price and income. Now, I was just looking at LA earlier. LA is 75%. So if you make the median income and you're looking for a median home price in LA, your house payment is 75% of your income. You can't afford a house in LA right now. That's expensive, Doug. So 30% is the cap, 75% is the median. What does that mean? That means you can't afford to live in LA for the median home price for if you're making the median income. You just can't do it. So where are you going to live? Well, if we're looking at California, maybe you move to, maybe you move to San Francisco or Marin County. Oh, that's 78%. Can't do that. Sonoma County. Well, that's only 60, but that's still double. 45% in Solano. I mean, you're looking at most of California and up and down the coast, you're looking at 75%, San Jose, 74. It's not affordable. Okay. So it's a real problem. Now you could say, well, yeah, but house prices are coming down. Sure they are, but are they coming down enough? Well, apparently not yet. I'm in Boston. Let's look at Boston. You're looking at Middlesex County, which is a nice area. That's 47%, which is reasonable, but still expensive. You got Suffolk County. You got Essex, 50%. You got Suffolk County, which it's not showing up here because the map is really small. But here it is, Suffolk County, 58%. Well, that's great. The Cape is 57%. So there's a lot of places here. New York, 43. All of these places are well above what a normal bank would lend to you. So, if you want to live in these areas that people want to live, it's going to be really hard to afford that. Now, people talk about people moving out of New York. Well, there's a lot of reasons people are going out of New York. Part of it's the politics. Part of it's the way they handle COVID. Part of it's that it's really expensive. And if you don't have to live there, why would you? So if you can work virtually, go live somewhere else. But this is also part of it. You can't afford to live there. I think there's somebody just told me in LA, there's a 30% vacancy in offices in LA. 30% vacancy.
CRE is a big, big concern right now.
Right. It's a huge concern. So, people listen to us talk about this and I get pushback. Well, it's all supply and demand every single time. Supply and demand, there's not enough supply. Really? 30% vacancy? That sounds like a whole lot of supply. Residential, what was the number we had last week? 9.7 million houses that are owned and vacant. That's a whole
I,
lot of
I believe
inventory.
that number was 12 million.
Oh, sorry, I was trying to be nice, Doug.
Yeah,
Apparently.
you were being really nice. You're counting the 3 million that are cabins that are supposed to be vacant. It's 9 million that they're actually trying to rent, I think.
Yeah. So, it's, I mean, and to be fair, there's so many different statistics out there. I mean, I was looking at one of them, and it's like, well, out of 144 million housing units, 131 million are occupied, which, I guess that adds up. That adds up to close to the numbers we're talking about. 13 million houses sitting vacant is the numbers they used. So that's 10% of supply. 10% of the housing market is vacant. Now, to be fair, it's not on the market, probably because they couldn't sell it and make money. But the point is supply and demand is not the problem. It's not. There's plenty of supply. The problem is that it's unaffordable, right? So if you think of a supply and demand curve, let's go back. Let's bore everybody to tear dugs, and let's go back to Econ 101 in college, assuming you went to college, assuming you took Econ 101. I wouldn't have if I wasn't interested in it. Sounds like a boring class to me. But you take the supply and demand curve, right? It's basically on one end of the axis, you've got the number of units, and then you've got the I'm gonna have to go back to my econ book. Basically, I'm just gonna botch it. Let's just say there's a big X, okay? I'm gonna sound like an idiot. I had a lot of fun in Memorial Day. So let's just put it this way. So there's the supply and demand curve, right? There's the amount of supply in the market, and there's the amount of demand. So if there's a whole bunch of supply, well more than demand, the prices go down. If there's not enough supply for the amount of demand, then the prices go up. That's the basics of this, right? So if you look at supply and demand and you've got a whole bunch of houses that people don't want to buy, then it's not worth that price. So if everyone's pricing their house at $1 million and I can only afford $500,000, well, and everyone else can afford $500,000, let's use the example, then those house prices aren't worth $1 million. They're not. You can call it 100 million if you want, but if nobody buys it, it's not worth 100 million. What it's worth is what somebody else is willing to pay you for it. So the only metric we have for house prices is what is moving. Now there are stupid buyers and there are semi-stupid sellers, right? The people who are overpaying right now, I would call unless you have to, and I'm not characterizing people as stupid, but if you're overpaying because you feel like you need to get into a house, then you probably don't listen to the show, so I'm not offending you. So you think about it this way: if a house is worth $500,000, you're paying $1 million. That's a dumb decision, but it doesn't mean that there aren't people out there willing to make that decision. There are plenty of people who will make that decision. There could be a whole bunch of reasons, right? There could be gold buried in the backyard and they don't know about it. Could be a Monet in the attic. I don't know. But the point is there are people who are always going to be at the extremes. Someone is always going to pay $100 million for a house that's only worth $20 million. It happens in art, happens in houses, whatever. But there's a certain point where you just can't afford to pay it because you don't have enough money saved. The interest rate is too high. You can't afford the payments, whatever it is. So at some point, most people are just going to say, I can't move, so I'm not going to pay that. And eventually, people are going to have to sell, and you will get prices that are going to drop. That's why it's a 5-year top to bottom cycle. On average, it takes an average 5 years for a real estate cycle to top and to hit the bottom. Look at 2005 was the peak of the real estate bubble. It bottomed around 2010, 2011. Like, that's where it bottomed. That's close to a 5-year cycle, right? And it's only 1 year in, 1.5 years in. It's still really early. So if interest rates drop to zero, then I've reserved my right to change my mind. But as long as they're going to remain high, which I think they will, then at some point we're going to hit a stone wall and people are going to have to face the music and sell for lower because they have to. But it doesn't have to happen right away. So anyway, just wanted to throw that in there. I think it's really important. But, Doug, obviously they've the government's they still haven't made up their mind, even though they're kind of on the same page. They haven't kind of crystallized the deals. How's that impacting the markets? What should people be looking at right now?
Where should people be looking at in terms of where to put their money?
Anything,
Right.
opportunities, like how should they be looking at this debt ceiling problem that's now it's all saved. It was a problem, but now everything's okay. I mean, how
Well,
should they be looking
yeah.
at that?
Well, I think you made a good point and some off conversation that we had, Kirk. Might start be a good time to might be a time to begin start looking strategically at buying debt. And I think, one of the things that became a real problem in the former time frame of low interest rates is that, as we are starting to see now, debt was one of those things where always has a risk, right? What's the risk of owning debt? And the risk is default. The risk is that people can't pay. And we take a look at what's going on now. I want to come back to what we just talked about. It's like you talked about the 9 or 12 million homes that are unoccupied. A lot of those have now become Airbnb or Verbos. And guess what? Who's the number one user of those? Gen Y and Gen Z. Who are the most strapped right now in terms of housing? Gen Y and Gen Z. Who are the most strapped in terms of student loans? Gen Y and Gen Z. Do you start to see a rippling effect here, right? And if we take a look, it was an interesting comment that we were talking about the history of kind of what's going on here. I saw someone had made a point or had made a quote to say, look, what's the impact of student loans? Didn't banks always take into consideration the impact of student loans? Well, absolutely they did. But student loans were, if you go back pre-COVID, right, before they cut off student loans, interest rates were 3-4% for a house. So the payment was, let's just say, $1,500 a month. Now you get to today, the payment's $3,000 a month. Student loans payments weren't even being collected during the last 2 years. So we've already seen a doubling in the cost of the student loans. Now the mortgages. Credit card debt has gone up, which means probably more debt service per month on that now too. Now you add $500 more. Guess what, Kirk? Who's going to be able to afford to do those Airbnbs and those delivery services? It's a domino effect, right? They're getting squeezed. Now, the last thing that people don't pay is always going to be their housing, right? Why? Because you can stop paying your credit card bills and there's nothing that they can really do to you except a lot of really nasty phone calls, right? And they can start cutting off the cards and other things. But you know what? You'll figure that out later. But the day they come and kick you out of your house, it's a whole different story. Everything collapses. So, it's one of those reasons where mortgages have always been kind of a safe debt, in the fact that people will try their best not to pay it. But there comes a breaking point where all of a sudden that can no longer be handled, can no longer be managed. And so, we go back a couple years ago with debt and the risk that was there with debt. The thing is that a lot of these, especially the banks, they weren't collecting a premium on the amount of risk that was out there. It kind of reminds me of 2008 when, you were getting these low interest rates for bad credit. Where is the help to cover the risk of default for those lenders? And I think now you're starting to see finally a payment for the risk. And we're starting to see that interest rate go up. So from a new debt issue type of standpoint, high yield debt, for example, Kurt, if you can get floating rate debt, that's going to be something as these interest rates are going up, and you're going to now be able to get paid potentially at 7, 8, 9%. You're starting to get paid for your risk. I think that's definitely something we've already seen. It depends on where interest rates are going, but at least now the interest you're getting off of it might be a little bit more worthy. And I think as we start to see new issues on other types of high yield debt, you're finally going to start to see some issues there. The one place I would be very cautious of is going to be small caps, right? Small caps tend to be much more sensitive to what's going on in the local economy. And as we start to see households begin to get more and more squeezed, you may start to see, and a lot of, and again, small caps, there's the small cap public market, and then there's the small cap private market. And, small business owners, if, that might be in more of a niche, you start to see a lot of more people kind of come out with these businesses that are oh, lifestyle businesses or fun, or they got little more creative things that, might sell, really expensive, but who, nobody's gonna have a problem going out there and in a good economy and paying for, handmade soaps at $10 a bar. Those may not necessarily be the first consumer option in a tightening economy. So as M2 supply starts coming out of the system, I think I would be cautious of investing in things that are more of a discretionary item, as more of a luxury item, because people are going to start to come back. And I'm not a big fan of investing in consumer staples, Kirk, because long term, they're never a great investment. But you know what? Eventually, you typically are going to find that as people start to tighten up the purse strings, what isn't sexy in a normal economy is going to still be fairly consistent in a poor economy. So I think that's something to look at too. I don't know what thoughts you have, Kirk. There's a couple things that I'm thinking.
Yeah, and so I was reading an email over the weekend which had a ton of data, and I'm going to see if I can get this guy on the show. His name's John Burns. He's very smart when it comes to residential real estate, and I was reading some stats, and one thing was fascinating, and I'll ask you the question: what percentage of all homes, Doug, are owned by institutions, like residential homes? What percentage do you think is owned by institutions?
I know it's a lot higher than it used to be, given the investment boom. I'm going to go out on a limb, and I'm hoping I'm high on this. Is it 20%?
You are high, really.
I am high. Okay, good. I was hoping so. I know there's been a lot of buyout. What? 3%. That's it?
3. I was shocked. I thought it was
that is really low compared to what I was thinking. I figured it would settle in somewhere between maybe 5 and 10.
Yeah, I was figuring it was between 10 and 20, but 3% of all homes are owned by institutions. Wow. And a lot of them actually by the same institutions, and some of them are like funds that specifically do that. One's owned by Goldman, one's owned by Blackstone, Cerberus, there's a few others, but yeah, they're very few. And this is after the bubble we saw, where we had Zillow and all these other companies in the real estate space that were buying up homes like they're going out of style, and even then it still didn't even make a dent in the residential. Now stuff like that. Now I bring this up because the perspective we have on things is really important. Now when you have a perspective on the markets, whatever it may be, right? You have a certain. I actually just taught a class on this just right before this on mindset, right? And the important aspects of mindset are to understand that how you look at the world is based on a handful of things, okay? So one of those things that it's based on is your experience, okay? Your life experience. Now, Doug and I grew up with a different set of parents in a different part of the country.
Are you sure about that, Kirk?
As far as I know, Doug. Okay. Unless your dad's the mailman, I'm pretty sure they were different.
You read about those surprises now and then, random strangers. But, I think from what I can tell, there's enough differences that I believe you.
Yeah, I'm pretty sure a little different. But anyway, so, our mindset is influenced by our life experiences, right? It's influenced by our memories. And many of us have false memories. And there's actually a whole science behind this. So the memories we have are not as clear as we think we have, right? Like I'm watching a car going by and it's gray, and next month you ask me, like, oh, that car was black. No, I'm pretty sure it was black because I remember it being black, even though it was gray, right? Our minds sometimes have false memories, and so that can also affect our mindset. Religion, right? Social constructs. You have social groups, right? Friends, family, spouse, kids, peers, and upbringing. All of these things affect our mindset, right? And, if you look at, for example, look at politics, and we don't like talking about politics, but use this again as an example, right? You have Democrats and Republicans, who are the two major parties in this country, and they pretty much fight each other on every single issue. And they barely agree, which part of the reason why we have this debt ceiling debacle is because they can't agree on simple things. But you have these two parties and they look at the world, they can see the same set of facts and they can see the world entirely differently. And they both look at each other and say, Well, you only believe that because you're evil, stupid, or uninformed. And the other party's thinking the exact same thing. No, it's only because you're evil, stupid, or uninformed. And if you think about the other party and whichever one you believe in, you think that about the other party. Well, they think the same thing about you. Well, which is right? Well, you both could be wrong, right? Who knows? I don't know what's right. I'm not smart enough to know what's right and what's wrong. You know, it's your life experiences dictate whether you think it's right or wrong, and mine dictate something differently. Who am I to say that somebody else is wrong and I'm right? I could say that, and that's what most people do, but in reality, our mindset is constructed this way. We look at the world through a certain set of eyes that were developed based on our life experiences and influences. And whether it's politics or whether it's life or whether it's finance, it's the same thing, right? Oh, I believe buy and hold is the best thing. Why? Well, because somebody told me that 20 years ago and it's held true for 20 years, and so I believe it. Why does real estate always go up? Well, because it's always been the case, at least as long as I know, or so I've been told, until it isn't, right? So we all kind of have this mental construct of how the world should work. It doesn't mean the world should work that way. It just means that it may have been working that way, and so we're accustomed to it, or we think it should work this way, even though it doesn't, but we think it should, and we're trying to mold the world to our own mental model, which is always a bad idea. You have to accept things for what they are, and you try to mold around it. What was I'm going to botch this quote, but it's always like, you know, the irrational man sees the world as it is and tries to change it, and the rational man sees the world as it is and accepts it, and the world is changed by irrational men. You know, at the end of the day, like, it's irrational to think that we can mold the world around ourselves. And very few people actually change the world. You know, like the Elon Musks of the world, the Bill Gates, the people who form these great companies and change the world through technology or whatever. The world does change by those people, but they're few and far between. But what is a more rational approach is to look at the world and say, all right, I'm not going to change the markets to my will. So what can I learn from how the markets are operating now? And what can I take away from that? Well, one of the things is everyone lost a lot of money last year because the 60-40 doesn't work. Well, it doesn't not work. It just didn't work last year because stocks and bonds both went down. So you have to look at what I would take away from that is not 60-40 does work or doesn't work. What I would take away from that is you have to be mindful of the two pieces of the puzzle. Some years equities do well and bonds don't do well, and they typically offset each other, which is why the model tends to work well. However, when you have a time when equities are really overpriced and bonds are really overpriced because interest rates were low, eventually one or the other or both are going to have to decline. And that's what happened last year. But now is a different market, right? Do I think, you know, bond rates are going to keep going higher? Not in the short term. They eventually might. I can't tell you what's going to happen in a year from now with the stupidity of our politicians and policy and all the stuff going on in the world. I think rates could very easily go higher, but I don't know. But I think short term they're probably going to go lower. Even though mortgage rates have kept climbing, they were at 7 and now they're at 8. And even though rates and interest rates are dropping, mortgage rates are still climbing. So we can't know what's happening, but I think we can predict that there's a reasonable probability that rates could go up or down from here. I mean, you could flip a coin and say they could go up or down, and it's a crapshoot. Some of the smartest institutional investors say, hey, last year was the easy money, now we're in the messy middle. When I say easy money, I mean, it's easy to predict in hindsight that was easy, but from here, we're in the middle. Like, it'll probably go up and down and sideways for many years like it did in the 70s, and that's a more likely probability than assuming that the markets are going to skyrocket from here, even though one of the chip companies went up 24% with earnings, even though their revenue was declining. People thought it was a great show of growth with AI, and they said, oh, we're going to spike the stock price 24% up. I think that's ridiculous with declining revenue, but I'm obviously wrong because it went up 24%, right? If I was saying, well, that's stupid, it's already expensive, and shorted it, I would have lost a lot of money, right? So my opinion doesn't matter. What matters is what the market thinks of the stock. And apparently the market thought that, hey, this is a good idea because we want to invest in AI while it's young. even though it's got a lot of growing up to do. There aren't many ways to invest in AI, and this is one of them. And they think, oh, well, let's put all our money in AI, and this is the only way to do it. There could be a whole bunch of reasons it went up 24%. But at the end of the day, what I'm trying to impress upon you as listeners is that your perspective matters. And what you think about the world matters. But what's more important is that the market doesn't care about your opinions. The market could give two craps about your opinions. And you need to recognize that while your opinions matter, they don't matter to the market. And you need to put your opinions in the back seat, because you have to figure out what's more important, your opinions or making money. Is it important to be right, or is it important to make money? And I think this is one of the biggest lessons that I could teach on this show, that is something that probably 99% of you aren't going to hear. And I'm saying that from first-hand experience. I didn't hear it the first 1,000 times somebody told me, which is your opinions don't matter. What matters is what the market thinks. And you need to take your ego and shelve it, or put it in the back seat, whatever you're going to do. Take your ego off the table and know that you don't know the answer. As smart as you may be, you could have 10 doctorates in econometrics and finance, investing, whatever. Doesn't matter. Doesn't matter how smart you are. The only thing that matters is my perspective correct based on the market? That's all that matters. So if you want to make 5% and put all your money in 5% treasuries, and the market goes to 30 and you wanted 5 and you're happy with 5, great. But if you put it into treasuries and you're trying to beat the market, obviously not a good idea, right? In that scenario, right? So you just need to understand that it's not about being right or wrong. And as human beings, ego is so important to our mental stability. We need to feel like we're right. We need to feel appreciated. We need to feel like we're important. And when it comes to investing, none of that matters. You're not important. Your opinions don't matter. The market is what matters. Because you could be correct, and this is a takeaway from all the bearish people, and I tend to have bearish tendencies because I'm more of a value-oriented investor. I want to find things of good value, and I think, oh, this is expensive. So it's hard for bearish people to recognize this, but it's important to realize that you could be intellectually correct with your opinion. So whatever you think, the dollar is going to go to zero, we're going to default on our currency, whatever you think, you could be intellectually correct. But you could be wrong for 50 years, right? And if you're wrong for 50 years, what does that mean, Doug?
You're broke.
Yeah, it means you're wrong and you're broke, right? So being right and wrong is a perspective as well, and there's certainly variations of this. But if you're wrong 50 years, you're going to be broke, but you're wrong, right? And I think the challenge is when you introduce time frame to the equation. Right and wrong is a perspective, but time frame makes it real, right? Because if I say the government's going to default on their debt, which eventually we will, the numbers aren't going to lie. Eventually we'll default on their debt. I don't think it's going to happen tomorrow. People were afraid that we're going to, because the media told you that you're going to be afraid because we're going to default on our debt. That was the talking point on every media station. We're going to default on our debt. Well, the last time we went through this, the talking point was we're not going to be able to pay our government employees. Well, apparently nobody gives a shit. Sorry. So nobody gives a crap about government employees because no one cared, and we quote unquote defaulted. We just pushed it and people didn't get paid. Well, people didn't care enough about that. So now their claim was we're going to default on the debt. Well, why is that the first choice? You could certainly not pay your employees. That's a choice that would maybe be better. You could maybe not put money into pensions. That's another. I mean, there's so many choices you could make, right? I'm not saying one's right or wrong, but they could make so many choices. They chose to get your fear part of the brain riled up by saying they're going to default on the debt, which in my opinion is probably why we have 8% mortgages. I mean, they shouldn't. I mean, the numbers don't make sense for that 1 week, but that could be a reason. So what I'm getting at with all of this is that perspective matters, and you don't always make your own decisions, right? Like we talked about the government debt defaulting. I think they're going to default probably 10 years from now or maybe longer. It's not going to be tomorrow. It's not going to be the next day. If it does, it'd be really shocked because they have to choose to default. Our government has to choose voluntarily to default. We can print money until it's coming out of our ears. We can print as much as we want. We are not going to default as long as we choose not to. So if we default, it's because we chose to. Or in 10 years, when pensions, Social Security, and Medicare all default at the same time because they run out of money, you could argue that might be a default, but they just print money. And then it's just a question of how bad do we want to look to the world. So that's not going to happen today. So anyway, I just kind of want to rant there, Doug. What are some of your thoughts?
Well, I think the biggest problem you're going to have is, and again, what everybody talks about hyperinflation, right? Oh, it's coming and all the money that we printed. Well, inflation didn't really come until COVID. COVID caused inflation. We know we've talked about this ad nauseum, bullwhip effect. We finally had all this extra money and not enough goods and services. There you go. When we had lots of extra money, but lots of extra goods and services following 2008, 2009, no problem, no inflation. What's going to happen? One of the biggest issues that I think about the debt side of it, you just talked about with the government. I don't know if it's going to default because they get to make the rules, right? They get to work with the Federal Reserve and come up with what they want. But what is going to happen is if the government even continues to spend the amount they're spending, and by the way, this is interesting because I'm hearing that there's going to be balanced budget requirements coming out of this agreement. We'll see what that means. But if they do end up just continuing, let's just say there's no inflation and the federal government just continues to keep the same amount of spending. Unfortunately, the amount of debt that they have already continued to service eats into that revenue, and therefore it eats into that spending on everything else, which forces them to take on more debt because they don't have enough income to do it. Not that the spending doesn't go up, but if let's say the income can't go up. So yeah, there's going to come a point, Kirk, where we're going to have a breaking point, and I don't know when that's going to be either. All right, people talk about all the time, is there going to be Social Security is going away? You have your opinion, I have my opinion. There's lots of opinions on it. Is it going to collapse and go away? I don't know. It's a payment in, payment out system, kind of like a water pipe. There's always going to be some water going in, and there's going to be a lot of water being taken out of it. Now, does that mean that it's going to go dry? I would argue it's never going to go dry, but it certainly means that the amount that can be tapped into it is going to diminish at some point. But you know what? It only takes a couple things that the government decides to do, like changing the date of when people can take full retirement. Maybe they make you wait till 75, right? Well, nobody's going to tap it anymore then. Maybe they take away early retirement. Maybe they raise the Social Security tax. Again, there's too many variables on everything to be able to have a solid and factual opinion, which right there is a contradiction, right? Factual opinion. Go to social media anytime and listen to what people actually declare is a fact versus opinion. And it tells you how little the average person understands about what fact versus opinion is. An opinion is nothing more than an idea backed by nothing more than an idea, right? And you can say whatever you want in its opinion. You cannot call an opinion fact. Facts generally still get debated. We know this over the last 2 years, right, Kirk? What are facts anymore, right? Well, there's this research that proved this, but there's all of this belief that research was wrong. It's gotten to the point where opinions dominate everything. They always have. Opinions are like, what's. Everybody's got 3 of them, I guess. But the point, but with that, it's going, and like you just talked about, in terms of trying to beat the market, trying to predict the market's always going to win. Why does the stock market continue to roll and roll and roll every year? Okay, even though we've got all of these negative things that are happening. Again, should have collapsed by now. There's enough negative things to cause it, but it hasn't. Okay, but here's the point. At some point, it might, and that's all I can tell you. The data is there to tell you that there are incredible challenges that corporations and people and government are facing. All of that should lead to a concern or lead to a lack of ability to invest. but yet we continue to see these things go higher and higher and higher. And people tell you that 2008 was different and this time's different. You know what? We have a lot of things that are happening now that are different than they were before. A lot of it is computerized investing, high frequency trading, lots more lots more retail investors than were ever there 15 years ago, thanks to the likes of the Robin Hoods of the world and all of the and Clovers and all of these different things that are out there allowing everybody to invest. So all we can say is that, again, I tend to be a little bit more bearish driven too, because I look at what's going on out there and say, can this really go on forever? And this should happen under these conditions. But time and time again, it's been proven that those conditions don't necessarily lead to the results that people think they're going to lead to. Okay. And with that, it comes back to the old assumption is, stock picking is a dangerous game. Timing the market is a dangerous game. But at the same, and it comes down to a long term, if you don't have a strategy, if you're jumping around trying to follow the emotion of what's going on and trying to predict what's going to happen, what's going to end up likely at the end of the day, Kirk, you're going to be wrong. Yep. But if you have a strategy and you follow that strategy and you get the emotion out of that strategy and you stay disciplined to that strategy, even if you're a perma bear, you're probably going to be right enough at some point under that strategy that it's going to pay off. We've seen tons of billionaires, hedge fund, perma bears out there that are incredibly successful because they know their strategy and they stick to it. Okay. And they understand what they're getting into. But this is the problem with most investors out there. You let emotion drive you with everything. Like, why would someone want to get into a house right now? Because they have been told, what was it? Was it Freddie? Was it Freddie or Fannie that came out with the first advertisement on that? Fannie.
Yep.
They came out with this. They came out with an advertisement that created emotion that the only thing to create wealth is to own a home. And as we've talked about ad nauseum, there's causation and correlation. Right? Is there a correlation between owning a home and being better financially? Absolutely. But is it a causation? Well, not necessarily. Maybe it's not getting the home that makes you wealthy. Maybe it's the fact that you were better off financially in the first place that allowed you the affordability of the home and therefore more people that are affluent to begin with or have homes. It doesn't necessarily mean having a home creates wealth, but people take that data and create that causation from it. And so what do we have? We have people out there right now that are going out saying, I've got to have a home, right? Because if I have this home, I'm going to be better off. But what have we seen? The data now says that financially, and the numbers alone, it may not be better for you, whether you want to be more mobile, whether or not you have calculated all the maintenance costs, or you're in an area where home prices are truly more expensive than rent. And yes, maybe rent prices go up every year, but if you're fully extended on a mortgage well beyond what the rent is, guess what? You're never going to have to worry about the fact that the mortgage price isn't going to go up because you bit off more than you could chew anyway. And what if you lose a job? Now, what do you do if you own a home versus renting? So I think the key here is that I'm trying to get at is all of these opinions, all of these decisions, all of what the government was and the news and what the real estate industry they're doing, they're playing on your emotions. Stick to the strategy, stick to discipline, and at the end of the day, take a step back and understand if why you're saying you want to do something, why you're saying you want to invest in something, why you're saying you want to buy something. Is it based off of some logic? And I know it's hard to take people from emotional logic, but you have to do this yourself. Is it based off of logically the best decision, or are you feeling that pressure because of emotion? And if you're feeling the pressure because of emotion, more often than not, it does not end up a good outcome.
Yeah. So I want to share. So I was reading a book, and we're kind of we're tilting a little bit into a different topic, but in the interest of time, we'll have to wrap up soon. So this past weekend, I was reading a book called AI Superpowers: China, Silicon Valley, and the New World Order. I can't see it. This apparently is not showing up. There we go. By Dr. Kai-Fu Lee, who is the former president of Google China. So the guy's not a dummy, right? And he has a background in Google. He knows what they're doing. There was one chart in there that was fascinating. I'll try to put it in the show notes, but it was talking about the risk of replacement, what AI can and can't do, and there's an aspect of cognitive labor and there's an aspect of physical labor. Now, I think physical labor, certainly there's aspects there that are interesting, and we'll get back to that. I'm not sure I agree with all of what he's saying, but from the cognitive labor, which I think is probably most of the listeners here, he has this grid where there's the danger zone, the safe zone, the human veneer, and the slow creep. The human veneer is basically AI is doing all the work, and the human is on the outside, so you don't see the AI, but they're using the AI to do all the work, and the human is the interaction piece. The slow creep it's an area that's basically it's creativity based, but eventually it's going to get taken over because AI has. I think we originally thought that computers and technology would take our logic brain jobs. That was what everybody thought, and apparently it's the exact opposite, where it's taking away the right brain jobs or the creative jobs. And that's what AI is taking. So the danger zone, I'll give you a few examples: radiologist, customer service rep, personal tax preparer, insurance adjuster, telemarketer, basic translator. Safe zone: CEO, criminal defense attorney, psychiatrist, PR director, social worker, concierge. Then you've got the slow creep, which is graphic designer, financial analyst, artist, scientist, medical researcher, columnist. I find artist interesting, and most people are like, well, why is it taking the artist job? In many ways, art is a series of formulas, and some people know them. Like I was talking to a guy who's a comedian. He's like, well, comedy is just a series of formulas, and people haven't sat down and thought of it this way, but it is. There's like a formula you follow, and that leads to a funny joke. Not all jokes are funny, but you can follow the formula and you have more success than less. And people don't know the formula, they just kind of maybe they get lucky. But there is a formula to that, and that's just an art, right? And people talk about the science of art too, like the golden ratio and a few things that kind of come into art and impact it, and it's a reflection of beauty. I think it's really important to understand. And then the human veneer, which is like wedding planner, teacher, doctor, financial planner, remote tutor, tour guide. So I think what we need, and I wanted to read these through because AI is becoming a more and more integral part of our economy, and it's still early. And people are fighting back, they're going to take my jobs, like kind of attitude, and that's certainly going to happen. And it's going to create other jobs. But what's fascinating to me, so I've been hearing this for the last 10 or 15 years, that a lot of people in Silicon Valley have been pushing this idea of UBI, or universal basic income. And my immediate thought is, here's a bunch of rich wackadoos who think they know better than everybody else. What I think is better than you, and I'm smarter than you, and you're just a bunch of rubes. You don't know any better. To me, that just stinks of, hey, you don't deserve your freedom. I'm smarter than you, so I'll tell you what to do. There's a bunch of words for that. We don't have to get into that now. But the point is if you're looking at this concept, any other technology, I wouldn't hold a candle to it. With AI, things are a little bit different. And I think what's different about it is the unknown unknowns. We think like, all right, we look at today and say, all right, AI is going to take some jobs, it's going to make some jobs easier. But eventually it'll get smart enough where it's going to be smarter than human beings, and then it's going to be able to do a lot of the jobs that we're doing right now, and we won't need humans to do those jobs. So when you kind of think about the big equation, it lands up with 50% of the people are going to be unemployed. Now I understand why they're talking about universal basic income. I don't agree with it because I think that there's always this thinking, when they came out with the printing press, with the internet, with any sort of revolutionary technology at the time, the claim is always it's going to destroy jobs. People are going to be unemployed everywhere, and all it comes down to is just a retooling of the economy and of jobs. And so I do think there's a lot of questions that I don't have the answer to. So I'm not going to sit here and say I have the answer and this is the best way. But I will say there has been a framework that's been in place for hundreds of years where this has been the case, where people always think it's going to take all the jobs, and all it does is cause people to learn new jobs, and it creates new jobs. So I would also introduce that framework, but I do understand where they're coming from. If you're looking at only half the information and saying, well, I don't see how they can get around it. Well, someone will come up with a solution, right? Maybe it ends up, people go into outer space, whatever. I mean, the dynamics are always changing. It's just a matter of how. So I bring that up because AI, we're going to be talking about AI a lot in the show over the next few years because it is increasingly become a part of our economy. People are still trying to figure out how to use it. It is starting to get used. There are apps, there are companies who are kind of using it. Frankly, it's been around for a few decades. It's not new, but this new iteration, the human interaction is newer, and that part is scaring a lot of people. So, we'll keep touching on this because to me, if you had to understand one aspect of the next 10 to 20 years, it's going to be this. If you understand the impact of this in the next 10 to 20 years, you're going to make a ton of money. But frankly, I don't think people totally can at this point. I think it's still really early, but I do think that the people in control of the prompts and in control of the access are going to be the ones with power. So take that with a grain of salt. Whoever's in charge of the machine or access to the machine more accurately are going to be the ones with the power, and those are the people you have to be mindful of, whether it's investing or if you're worried about your own self-interest. Just be wary of that. But I think from an investing standpoint, there are a handful of companies that are in that space, and they're going to get a lot of mileage out of it. So just spend a little time understanding who they are. So Doug, why don't you wrap it up here for us, and we can take it home.
Yeah, so I just saw a tweet not too long ago where a mortgage expert had mentioned that 75% of the families that were coming in trying to borrow for their first home, or not necessarily their first home, but just trying to borrow for a home, were carrying student loan debt. Okay, so and now the question was, well, haven't they always considered student loan debt? Absolutely, they've considered student loan debt. But as I said before, student loan debt used to be a lot. First of all, nobody was had to pay on it for 2 years, and the mortgage amounts that people had to apply for were a lot less 2 years ago than they are today. So now you're running into an issue of being able to qualify for a home. That's not saying you want to qualify for a home in these conditions, but sometimes you have to. But you're running into conditions of qualifying for a home in these conditions with more pressure on your cash flow. And the banks, they're not taking risks right now. They're scrutinizing, they're more rigid, and they're certainly looking at the overall cash flow. You talked about that 30% rule into whether or not they're going to lend and how much they're going to lend for a home. So listen, it's no joke. Student loan debt is a serious, serious issue. And if 75% of the people applying for a mortgage have student loans, it's telling you that more people have student loans than you think do. And you may be saying, well, I won't be one of them. It's turning out to be a significant crisis. Look, so when it comes to planning for college and whether or not your child should go to college, whether or not you're going to go to the right place, and if it's going to be affordable for you, you have to start thinking about that now and building a plan along with everything else about how you're going to pay for college. So do me a favor, go to procollegeplanners.com. Download our free checklist to learn about the key numbers for college. You have to know those numbers so before you start doing anything else, so you're prepared and can be lined up appropriately for going into this college process, so you don't end up being one of these statistics. Go there right now, procollegeplanners.com, get your numbers, and if you have any questions, let us know. We'd be happy to talk to you about it.
Great. Well, thanks again for joining us, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube, so please check out our YouTube channel. As we speak, we're also live on YouTube, so it'll be pretty interesting to hear me say that. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, or maybe just another explodable drone, just like everyone else has been sending. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.